Yeah. Okay, guys, so welcome to tonight's webinar. This is going to be our 6th or 7th webinar. So we're consistently doing these every month. So today we're going to be talking about how to navigate high interest environment and a little bit of a market update on what we're seeing and how we're still acquiring the assets in this environment. Okay, so today we have in our table of contents a little bit of introduction to the team, understanding the real estate cycles and how they work, the top 7 ways we are navigating today's high interest environment, seizing advantage of inexperienced operators, our top 5 myths about high interest rates, a little bit of a Q&A, and then finally we will do a conclusion.
All right, here we're gonna have a bit of an introduction about who we are for anybody that is new. So who is Ortiz Equity Group? We are a team of experienced real estate professionals who specialize in acquiring and managing multifamily properties in the US. We understand the challenges of investing in real estate, especially when you are short on time. That's why we offer a passive investment opportunity that allows you to invest in a diversified portfolio of multifamily properties without having to worry about the day-to-day operations. Now, our team has over 50 years of collective real estate experience and has a track record of success across various industries, ranging from hospitality, real estate, technology, government, small business, and finance. Collectively, the track record includes 19 deals completed to date, 5 full cycle deals completed to date, 2,400 units under management, 120 million asset under management, and 250 million in total transactions. Some of the states include North Carolina, South Carolina, New York, Florida, Texas, Georgia, and so on.
Awesome, thank you for that. So the first thing we're going to be talking about here is understanding real estate cycles. So what is a real estate cycle and how do they work? Real estate cycles are recurrent patterns of market fluctuations that encompass 4 distinct phases. The first phase we have is expansion, the peak, the contraction, and the drop. These phases reflect the dynamic shifts in property demand, prices, economic activity. So by understanding these cycles, investors can navigate the market more effectively and make informed decisions. Here's a brief overview of each phase. So the first phase we have is recovery. So it's usually a seller's market. I believe it was just, today's date is 2023, August. I want to say earlier last year, we were definitely in a seller's market. I think more on the expansion side. And now we're getting closer to the hyper supply, closer to the recession, I'd say. If not, we're already in a recession. But what some of these cycles include in the recovery cycle, it's a seller's market, decreasing vacancy, low construction rates, low rental rate growth, and moderate observation. And the expansion cycle is usually, again, a seller's market, decreasing vacancy, high construction rates, mod to high rental rate growth, and moderate observation. Now in the hyper supply, which is now as you can see on the graph here, the graph starting to go down, now it's starting to become a little bit of a buyer's market. And I want to say that we are probably somewhere in between here, if not already close to the bottom here. Now with the buyers hyper supply, it being a buyer's market, it increasing vacancy, there's a mod to high construction rates, mid to low rental rate growth, and then low absorption. And then in the recession, which is 2008, I'd say if not, we're pretty much getting close to, if not already in a recession with just inflation and just high interest rates. Now this is usually causes increase of vacancy, low construction rates, low to negative rental rate growth, and low observation. I think, if we want to talk about the market, I wouldn't say there's a low rental rate growth. I think there's
I was actually going to say that they can feed off each other. So if we're in a hyper supply buyer's market, depending on the market that you're in, it doesn't necessarily mean that there's going to be an increase in vacancy. It's actually the opposite. So
yeah, so every market's a little different. I think right now is a bit of a hybrid, but yeah. So the power of multifamily real estate and market cycles. So in the world of real estate and market cycles, multifamily properties shine a dynamic and robust investment option compared to single family homes and other asset classes. Here's one. Optimal investment timing. Data between 1978 and 2018 Multifamily properties yield an average annual total return of around 9.75% during expansion phases, surpassing single-family homes returns of 8.5%. Multifamily resilience and attractive returns make it a wise choice across market fluctuations. So that's definitely what we've seen is with the market being the way it is. It's still an attractive vehicle. Multifamily is still an attractive vehicle because of the amount of units and so on. The second point we have here is risk management and stability. The data shows here during the 2008 financial crisis, multifamily rents dipped by only 2.7%, while single-family home prices fell by 27%. I mean, that is a huge difference. Another point here is multifamily stable rental income cushions against market volatility compared to single-family properties and other asset classes. And I'd say that's probably one of our favorite reasons why we love multifamily, even though there's high interest rates. It's still a much better vehicle than the stock market, which is down big right now. Mutual funds are down, crypto, I mean, it's non-existent at this point. So multifamily still holds those fundamentals that you're looking for in an asset class. So that's definitely one of my favorite things I would say about multifamily. Now, the third point we have here is enhanced cash flow and stability. Data. So the data shows here that rental income for multifamily properties grew at an average annual rate of 2.4% during expansion phases. And I'd say during COVID, probably way more than that in terms of the average annual rate. Now, during expansion phases, outpacing single-family homes growth by 1.9%. Now, second point here is multifamily, multiple units generate stronger cash flow and economies of scale. I think that's probably one of the reasons why we are acquiring 100 plus units, because you have multiple units. Even if you have 10, 15% units vacant, you're still cash flow positive. And usually we're looking at what 60 to 55% vacancy is usually the what do you call it, break it even point?
The break it even point, that's correct.
So that's one of the things that we love about the larger multifamily. And the fourth point here, we have strategic planning with diversity. The data shows here on average, the US experienced a recession every 7 to 10 years. In 2008, so we're looking at 2023. So yeah, this case being a little bit more like 12 to 13 years, but on average, impacting different property types variability. Now, multifamily diversified income streams mitigate risks and ensures persistent performances. And I think one thing I wanted to add here is that obviously with multifamily, the way it's valued, and I know we'll get into that later, is obviously based on the income. So that's the huge difference between, I would say, between multifamily and single family, aside from managing and other things.
Absolutely. Here we're going to be talking about multifamily advantage and data and what drives its success. So data backed up performance. So a point here is that historically trends show multifamily consistently outperforms single family homes in returns and stability. And the trends that have been shown for many, many, many years. Multifamily historical data stability. Another one is the margins correlate with population growth. The US population increased by 11% from 2010 to 2020. And the multifamily high density nature suits urban population growth, aligning with market trends. Another one is the financing and scalability. So multifamily properties attract lenders due to their reliable cash flow, easing financing during the market contractions. Multifamily reliable income stream facilitates access to finance. Here we have resilience and portfolio strategy. So the data, the US experienced 8 recessions since 1980, impacting various property sectors differently. Multifamily consistent demand and income make it a cornerstone for long-term portfolio stability.
So now we're going to be talking about how we're seizing opportunities across real estate cycles and multifamily investing. So how we take advantage of these different phases of the market. In this case, we're talking about the expansion phase. So multifamily advantage. So how are we taking advantage of this is, or some of the multifamily advantages here is strong population growth and employment trends drive rental demand, which we're seeing a lot in the market. I believe even whether interest rates are high, most people can afford a house, so they're going to go towards renting. And then when interest rates are low, some people get bid out of the market. So then they, again, go back to the rental. So either way, people are going to be renting one way or another, no matter where the market is. So what is the opportunity? So is to acquire multifamily properties for rising rents and high occupancy rates. Now, the data here shows the rental income grows at a 2.4% annually during expansions.
All right, yeah, here we have the peak phase. So in one of the advantages of multifamily is resilient, offers stability and market uncertainty. Now, the opportunity is in refinance to secure stable rates, enhancing cash flow during contractions. And the data on multifamily rents dipped just 2.7% during the 2008 crisis, which I believe compared to the multifamily was around 27%. So huge difference. And again, it goes to show the reliability and consistency in multifamily, whether the market is going up or down.
Thanks for that, John. Now we're going to be talking about the contraction phase, right? With and the multifamily advantage here, the demand for affordable housing remains steady during downturns. I think especially in this DNA right now, there's a huge demand for affordable housing, and the government can seem to be able to keep up with the demand that we've seen in the U.S. Now, the opportunity, what is the opportunity here with this? To identify distressed multifamily assets for value add potential, which is exactly what we focus on here at Ortiz Equity Group. Now, the data shows that multifamily's income cushioned against the 2008 crisis. So even I know one of our mentors always talks about how he got pretty much killed in the 2008 crash when it comes to his rental portfolio. I managed that portfolio because across the city. Whereas with multifamily, especially the larger multifamily, it's all in one location. So it's much easier to manage. It's one asset, one closing, one lending. So it's a much better vehicle tool.
Yeah, and here through the drought phase, the multifamily advantage is that the drought offers discounted opportunities for value investors. And whereas the opportunity is acquiring promising multifamily properties at a lower cost. So this is through the drought phase. The data shows that timing acquisitions during drought yields higher returns and expansions.
Thanks, John. So now we're going to be talking about the top 7 ways that we are navigating today's high interest environment. As you guys may know, we're still acquiring assets even with this high interest rate where most people are sitting on the sidelines. We are still seeing opportunity and we're capitalizing on that opportunity. Just like the famous quote by Warren Buffett, be greedy when others are fearful and be fearful when others are greedy. So I think that's a big example of where we are in the marketplace. So the first and number one, I think the last 2 or 3 deals that we've participated in had assumable loans. And for anybody who doesn't know what an assumable loan is, an assumable loan is a unique financing arrangement in real estate where a buyer takes over the existing mortgage from the seller. This means that the buyer assumes responsibility for the outstanding loan balance, terms, and interest rate established by the original lender. Assumable loans can offer significant advantages, particularly in environments with high interest rates. Now, below are some of the benefits, and I'll get into a little bit of this right after this here. But so the enhancement returns. These are some of the benefits. So the enhancement returns. Throughout assumable loans, investors can tap into properties with lower interest rates, boosting cash flow and enhancing overall returns. Attracting tenants, we have here. Assumable loans lead to lower monthly payments, creating an appealing proposition for tenants seeking budget-friendly accommodations. We're definitely seeing that in the C-class assets here. Reduce risk, the stability of fluctuations. The last but not least, we have cash enhancement. For passive investors, offering property with an assumable loan can yield dividends. And just kind of give folks some more perspective here. The last 2 deals that we did, and including the deal that we're working on right now, the mortgage is 4.5% interest only for the next 10 years, right? So in the States, they are a little bit longer. So this is assumable. So we have assumable loan of 4.5% interest for the next 10 years at a fixed rate. So that means that regardless of where the interest rates are, is not going to impact us. And that's the same thing. The deal before that was 3.5% interest.
Yeah, so a lot lower. Some of the rates that you're getting right now are between 7, 8, sometimes even 9%. So assumable loans can be a great strategy when doing acquisitions for sure.
Yeah, and that's what we're seeing, that the underwriting is making sense when we do assumable loans. When we're going through lenders, we're starting to see that the numbers just don't seem to work. Unfortunately, just with what the sellers are asking and what the property is producing.
Yep. So another here is cosmetic renovations. The current high interest rate scenario, our investment strategy revolves around acquiring assets that offer sustainable advantages without demanding extensive capital expenditures or substantial ticket items. Instead, we focus on light cosmetic renovations that harbor immense growth potential. Here's why this strategy is a great tool for passive investors. So some of them are enhancing the profitability. Our emphasis on assets with cosmetic renovations potential ensures that our investment dollars are enhanced effectively, resulting in impressive returns on our investors. So this includes very light cosmetic or facelift styles, as they call it. So
and just to give people some perspective, some of the assets, like the asset that we just currently came from in Savannah, the budget that we have for renovations, especially on the larger multifamily. So this one we have $6,000 per unit. So that pretty much tells you the cost per unit that we're doing in renovations. I know here in Canada, you're looking at like 30 to 35%, to 30 to 30,000, $30,000 to $35,000 per unit, give or take, and that's with a good team. Some people I know they pay even more. So this gives you an idea of how we're able to implement our business plan. We're still able to get, more rent, but $6,000 per unit is kind of what we're
and this
6 to 10,000.
renovations like flooring, upgrading the bathroom, nothing, etc. Mitigated financial risk, it's another one. So by passing large capital outlays and focusing on light cosmetic rentals, we reduce the financial risk that often accompanies significant expenditures in high interest environments that rather focus on adding value via turning units over. And consistent upside. So another upside on this strategy is investing in assets with potential for light cosmetic renovations means unlocking substantial upside while maintaining stable cash flows throughout the ownership. Strategic stability. So this means that strategy aligns with the goal of maintaining the property value and market competitiveness, and establishing the negative interest rate fluctuations with confidence.
Thanks for that, John. So again, guys, we're going over how some of the things that we're doing to navigate this high interest environment, and some of the things that we're seeing that are working. So the third thing we have here is stress testing the deals. For people that don't know what stress testing is that when you're doing your underwriting, you're stress testing the deal to see what's the
break-even point.
What's the break-even point on vacancy? If the interest rates continue to go up, what is that going to look like on the underwriting? And then last but not least, what are projections for the rental growth in that market? I know over the last little bit, a lot of operators were running their numbers at like 10% growth year over year, which is not sustainable if you think about it, since your rent is based on how much income you make. So people are now making a whole lot more money, but yet the rent is going 10% year over year, which is just not sustainable long term. So that's what stress testing is. And now we're going to go over here some more points. So our approach involves stress testing multifamily deals by analyzing how properties perform under higher interest rate scenarios. So what this does is it provides a proactive understanding of potential impacts on cash flow and returns. So by us stress testing it, we can kind of predict the future in a way and see what things would look like. And it allows us to be better prepared. So again, proactive assessment. We always stress test our multifamily deals with higher interest rates in mind. This proactive approach helps us understand potential cash flow and impacts and make informed decisions. Resilience assurance. The stress testing ensures our deals can withstand market fluctuations, like what we're going through at the moment. The resilience safeguards our investors' investments against uncertainty and maximizes long-term stability. Informed decision making. By evaluating deals under various interest rate scenarios, we make strategic investment decisions that align with our investor goals, even in challenging market conditions. Fourth point we have here is risk mitigation. Identifying vulnerabilities early allows us to implement effective risk management strategies, ensuring optimal financing structures and property performances. Last but not least, long-term success. And again, I think that's one thing that a lot of folks may not have in mind, is that real estate is a long-term play. And although we may be going through some high interest rates at the moment, we are looking at a long-term play.
Projections, long-term plan.
Yeah, 20, 30 years, right? And, by you not acquiring assets at this moment, then you're going to be missing of opportunities and you may regret it later on in life. So last point here is long-term success. Our commitment to stress testing enhances the performance of multifamily investments over time. It positions properties to thrive in a high interest landscape and deliver consistent return. Four point we have here? No, I'm sorry.
So right here, we're going to be talking about avoiding ground up development and non-value add assets. So smart investment focus. So here, in response to the high interest environments, we make deliberate choices to steer clear of ground up development. Instead, we concrete on existing properties with substantial value add potential. And we will, I think we should touch a little bit on that is our strategy is extremely value add only.
In existing buildings, the important thing with that is that with ground up development, you are essentially trying to predict what the properties may be worth, right? So you're like, hey, let's say it takes you 3 years, you're projecting what the properties are going to continue to go up and what they may be in the future. However, there is no income coming in from the property. So you're basically bleeding money every single month. And if by the time you're done building, because obviously we got to understand that, all the materials are going up over time. So what would cost today is not going to cost the same that it costs in 3-4 years. And so materials getting more expensive. And if you're trying to predict the future and something like what we just experienced, like COVID happens, and that's what we're seeing. I know in Toronto and some other places, there's a lot of developers that have just kind of given up on their projects.
Yeah, even some of them are offering to pay 6 months to a year mortgage.
Yeah.
Just to try to get more people in.
Just to try to get more people in. Yeah. So it's not something that we focus on. Again, we focus on existing multifamily properties, not grown up developments. And yeah, go ahead.
Yeah, so here, what we focus on is value-centered approach. We avoid D-class or stabilized assets without value-add opportunities. Our strategy targets assets where enhancement can significantly boost property value, attract tenants, and secure steady cash flow.
Yeah, and for some people that may not know what the different classes of properties are, do you mind sharing a little bit of what A class is and or what a D class is?
When it comes to
Multifamily.
multifamily, which essentially just is in a rougher area, probably lower income, economics when it comes to the neighborhood, probably a lot of
crime, yeah, for sure. A lot of
probably, underperforming and mismanaged assets.
Yeah.
I think it's a big one.
It's there. You're gonna have a lot of, so to give you more people more perspective, when you think in D class, think about shootings, stabbings, drug dealers, all the issues that you can think of from an asset. So even managing those assets can be very complicated, and it can be very give you gray hairs essentially, because you're just dealing with so much stress.
You will have to have an extremely powerful asset management team to be able to turn those units over. And it would have to make the most sense to be able to turn over a D class depending on the location, the deal structure, etc.
So for people that don't know, John, what type of assets are we acquiring?
Yeah, so we focus on B class assets, either plus or minus. And sometimes we also focus on B class assets that are in C class or A class.
Yeah. So we focus on B and C class. We don't do any A class type of assets at the moment, and we don't do any D class. So we're right in the middle. So typically, we like to find C class assets in B locations or B class assets in A locations. And A class assets would be a brand new apartment complex, maybe something that was built in 2000, early 2000, late 2000s. That's what an A class would be.
Even something from the ground up development.
Yeah.
Even just in the recent years.
And is there usually any value added with the A class assets?
No, there isn't really any value add because you already have the best market rents you can get.
One thing I wanted to add, because we were just meeting up with a property manager down in Savannah, and one of the things that she mentioned, which I thought was really interesting, is that your A class assets, have some of the highest turnover, and I think the reason for that, and some of those reasons that she mentioned about this, is because they're usually there very temporarily, whether it's 6 months, 7 months, 8 months, and they're usually just there temporarily, whether it's for work or whether it's just waiting until the house is built. Yeah, waiting until the house is built. Because these people are usually, more higher income. They're not typically there for longer periods of time, whereas the B class and C class, they're usually there forever. So yeah.
So the cash flow optimization includes to shying away from a financially viable to provide consistent income stream despite challenging market conditions. So what does that mean to you, Jeff? Can you elaborate on that?
Yeah, so basically, we always, when we're underwriting deals, we always make sure that they're cash flowing from day one, right? If you buy an existing asset and it's not cash flowing, and you're obviously, planning to implement your business plan, then it could take a long time, and it could be a long drought before you use distributions. So we typically have a huge upside potential. So there still is an opportunity to increase rent, lower expenses, manage the asset more efficiently.
Yeah.
Essentially.
Some of the risks reduction included are avoiding assets with limited potential for value and a struggle to thrive in a high interest environment. Another great thing about avoiding ground up development is sustainable returns. So our approach focuses on providing an attractive balance between potential returns and minimize exposure to uncertainties of new development or non-value added.
Thank you. And the point number 6 here is combining immediate returns with future upside. And I think we might have touched on this a little bit. In navigating the challenges of a high interest environment, our commitment to investing in cash flowing properties with future potential ensures a robust balance between immediate returns and sustained growth. So again, we're talking about immediate cash flow. Our investment strategy prioritizes properties that generate cash flow from day one. This ensures a steady income stream, helps offset the challenges posed by higher interest rates. Value enhancement. While focusing on cash flow, we also identify assets with untapped potential for growth. This strategic approach positions your investments to benefit from future value enhancements. And typically, when we're looking at an asset, we want to make sure that the rents can still be pushed. And I think some of the advantages of some of the properties that we got going on right now is that we already have an in-house property management, which have already executed a business plan on another asset. So therefore, we already have proof of concept, and it's pretty much already stable when it comes to that. Now, risk mitigation. Investing in properties that generate immediate cash flow provides a buffer against potential market volatility, reducing the risk associated with high interest environment. So again, I know a lot of people, especially in Canada, I would say, got caught with their pants behind, because they bought properties they shouldn't have bought, that didn't cash flow, didn't make any sense, all because the interest rates were low and they were just emotionally attached to it. They thought the price was just going to continue to go up. I know, especially in Toronto, buy condos for close to $1 million, and with still condo fees and just not smart investments, right? Let people know about this. Balanced strategy. Our dual emphasis on cash flow and upside potential offers a balanced investment approach, allowing you to reap immediate financial benefits while positioning for long-term gains. Optimize returns. By carefully selecting properties that deliver both cash flow and future upside, our strategy maximizes returns while maintaining financial stability in a high interest landscape. And one thing that I wanted to add to this is that a lot of people may focus on a market that just has cash flow. Are we only looking for cash flow, or are we looking only for appreciation?
The advantage of having cash flow from day one can keep your investors happy, while year over year you're turning over units and increasing the cash on cash.
Yeah, thanks for that, John.
Multiple paths to success. So when we're navigating the challenges of high interest, our focus on flexibility ensures that we have the freedom to choose the best path for each investment, enhancing the potential for success and safeguarding against uncertainties. So diverse exit venues. So our approach positions us to choose from multiple options, whether to refinance or sell. This flexible empowers us to adapt to changing the market conditions without being restricted to a single strategy. So that's another reason why we love the multifamily ad strategy, is because you're able to push your investment and then have enough room to either sell or refinance depending on the market conditions later down the road, of course.
Yeah, I think where a lot of people miss out is that they only have one option, right? Whether their only option is to sell, or their only option is to refinance.
If you buy an A-class asset and there isn't much growth in the 3 to 5 year mark, there just isn't a lot of meat on the bone for when you're selling or refinancing.
Yeah, and typically what we look for, because I know a lot of people ask me, hey, well, are you going to refinance or are you going to sell the asset? And what we do is when we have executed on our business plan, we take a look at the asset and we say, can we get our 80 to 90% of our investors' capital back and still have a cash flowing property? And if the answer is yes, then we will refinance. But if the answer is no, then we typically will sell the asset at that point.
The other one is strategic underwriting. Underwriting deals, we ensure that both refinancing and selling scenarios are viable. This protects us against being forced into a single option due to unforeseen circumstances. So, our underwriting is I would say top notch at this point. It's an art in real estate that you're always going to have to learn. It's always changing throughout the market.
And I think what I wanted to add is that the larger multifamily underwriting, like we're talking 100 plus units, 200 units, 300 units, the underwriting is completely different than underwriting a 20 or 30 unit. And I think the main reason for that is because you have so many different income streams for an asset, and you have so many different expenses and so many different categories for each expense. So it can get very crazy, to say the least.
Property management, leasing office, maintenance crew, asset management crew, like it's a lot.
Salary, people that are on salary, because you have the maintenance, the leasing office. So anyways, there's a lot more underwriting and a lot more numbers when it comes to the larger multifamily. So I just wanted to add that to it.
Some of the risk mitigation by having both refinance and sell options available is we mitigate potential risk associated with the market volatility or unexpected shifts, providing stability in a high interest environment. And the optimal decision making essentially is our strategy allows us to make informed decisions based on prevailing market conditions, optimizing returns and ensuring that our investments remains aligned with your financial goals. So, this goals and strategies that we have are essentially the same ones that our investors have, which is to protect and grow their wealth through value add opportunities and be able to push that investment and make it grow over time. The balance approach is positioning ourselves for multiple option strikes, a balance between short-term gains and long-term strategies, offering the flexibility needed to thrive in a high interest landscape.
Thanks for that, John. And with that, that's the 7 ways in which we are navigating these high interest environment. Again, I think there's a lot of good golden nuggets in there. So hopefully people are getting some value from this here. Okay, so now we're going to be talking about how we're seizing advantage of unexperienced operators. And I think this is a topic that's talked a lot more now with the environment that we're in. So what we're talking about here is by leveraging data insights, we navigate high interest conditions, benefiting from unexperienced operators' challenges with upholding our commitment to conservative underwriting and strong fundamentals. And I know this is something that's talked about a lot. A lot of people were just buying deals that didn't make sense, overpaying for properties, not doing proper underwriting just to be able to close on a deal. And now they're being caught with their, with the pants.
With the market changing, essentially.
Exposes the real operators.
Yeah, that's why having a really good underwriting team and really good experience.
Proper reserves.
Proper reserves. So they can even, at least if you get caught between the fires, it can shift between month 2 to month 3. But that's to say the least.
We typically do like 6 months of expenses as a reserve. And again, if there's any big capital expenditure that happens that we didn't anticipate or anything along those lines, and we keep that money in a separate bank account and it's just there for whenever it's needed. Did you want to add something or?
No.
Okay. So now what we're talking about here is data-driven insight. And I think I would say larger multifamily is very, very data-driven and very, you got to look at the stats, you got to look at the numbers, you got to look at what's going on in the market. Not saying that the small multifamily isn't, but definitely nowhere near as much as the larger multifamily. So current data reveals over leveraged operators struggling with debt obligations and will not be able to meet DCR when the loans are due. So this is a huge opportunity. This is a huge opportunity for anybody who's been waiting in the sidelines, been wanting to get into multifamily. I mean, this is what we've been waiting for. I think we weren't able to take advantage of 2008. I think we were too young. I think we were in high school or something like that. But this market, we are going to be taking advantage, and we're going to buy as much assets that make sense as possible, and just ride the wave until we're long-term investors. So I think that's the benefit with that. So reserve challenges. Another factor is lack of reserves, and I think we just talked about that. So operators with inadequate reserves face difficulties managing unexpected expenses. Therefore, forcing these operators to sell at a discount. And I think we're going to see a lot of pain. We're going to see a lot of people who may invested with the wrong operators, and now they're going to be losing money, unfortunately. But with problems comes opportunities. So you gentlemen, thank you, Paul. Thank you, Paul. Paul just put positive comments here, so I appreciate that. And here, what we're talking about here is unrealistic rent projections. And I think this is very common, especially in some of the bigger markets. People just thought they were going to continue to go up. So what we're talking about here is a good number of operators basing projections on unsustainable 10% annual rent increase year over year over year. Now, what they're going to be experiencing is a lower occupancy and a high turnover. And again, back to the basics, the reason why this is going to happen is because the people that they're going to be trying to rent it, or the numbers that they're going to try to rent it to, those people, the numbers just don't make sense based on their income. Their income is just not sustainable enough to pay those rents. I think if I'm not mistaken, some of these markets, I think in some of these markets, they're trying to charge people like over $2,000 or $2,500 for somebody who's not even making close to that kind of income.
That's why undermanaged and underperforming assets is exactly what we look for. I mean, 10% annual rent increase is just, in my opinion, it's way too high. You should be following
2% is what that's the way we
less the minimum that CoStar has been projecting as an average in different areas, states and counties. Again, they all vary, but
yeah, 2% is a safe bet. I mean, depends on the market, but 2% is a good number to have. I know one of the big guys, Grant Cardone. I heard that some of his underwriting is projecting 10% year over year for the next 5 years. So get vested with him. Best of luck for sure. But great operator, billionaire. Okay, so floating debt risk, and I think that's also a big factor right now. Is there's a lot of floating debt out there. So basically, you have the floating debt, and then you have the fixed and variable, basically, to say the least. And a lot of people have floating debt, especially when repositioning assets. Usually, you would have some sort of not fixed rate, but you would have some sort of variable. So they have a variable mortgage. They'll have some sort of low bridge loan, and that bridge loan is the rates have gone crazy. So now they're panicking. They don't know what to do, and I think that's why we love some of the most recent assets that we've been able to acquire. Is they have already an assumable loan, so we don't have to worry about this, which is huge in this environment right now. So again, what is our advantage? Conservative underwriting and fundamentals position us to capitalize on unexperienced operators' challenges. Basically, plain and simple. With difficulty comes opportunity, and we're definitely ready to capitalize on the opportunity. And part of the reason we're doing these webinars to educate people, let them know what's going on in the market, let them know what we're doing to make the numbers make sense and to make the deals work. And yeah, so quality focus. Throughout conservative underwriting, we maintain a resilient properties that appreciate over time. Okay, so last but not least, we like to do this little thing at the end, which is the top 5 myths about high interest environment. And John will kick it off with the first one.
So the first myth that we came up is limited investment opportunities. So the truth is that high interest environments offer unique investment opportunities, often with stress assets available at a reduced price. Strategic selection and management can lead to lucrative returns. So what does that mean, Jeff? High interest rates, distressed properties, mistakes that were made along the way, where you can capitalize on, not necessarily, inexperienced operators, not to put anybody on fire, but, people that were essentially over leveraged in the market. Right?
Yeah. And they didn't do conservative underwriting. They're just riding the wave. The market was hot. rents were going up, but now things have shifted. I know I read a report that in Nashville, rents have
And I
actually,
think it caught a lot of people off guard.
Yeah.
Right, like interest rates were what, 2%, 3%, and everybody was happy, everybody was buying, nobody thought, 3, 4 years ago. And the ones that did, are gonna be protecting themselves, and the ones that didn't are gonna be losing on opportunity.
yeah, and a lot of investors' capital is gonna be lost along the way. So yeah, it's very, very, very important that the team that you work with, the operators that you work with, have a track record. They have gone through some hurdles and some issues, so that way you can be best protected. Okay, so the myth number 2, risk of negative cash flow. While high interest rates raise concerns, effective underwriting in property and property management can maintain positive cash flow, ensuring investments remain financially viable. And I think goes back to what we talked about earlier. If the property doesn't cash flow, you shouldn't be buying it. It's plain and simple. You're overpaying, you're over leveraging. I know that's been one of our biggest challenges, and I'd say in Canada and Ontario, is that the deals just never cash flow. Like you buy a building and it doesn't cash flow, and then you have to reposition it, and it's just I'd say very risky, unless you're working with a very experienced team, people that have been doing this, people that have a track record, people that have been turning units over, and there's just a process in place.
Yeah.
But with that being
And I
said,
think one of the things, and I don't know if we've done a webinar on this, we've done quite a bit now, but is due diligence. Right, and just one of the biggest things is to make sure you're going into what you're buying. There isn't anything missing. You're not finding a piping issue later down the road or some sort of accounting mistake or anything like that, right?
yeah. Myth number 3.
Yeah, limited property value growth. So the truth is that multifamily properties value appreciation remains viable in a high interest climate. Investments, value add opportunities, and active management can provide consistent growth since its value is based on its net operating income, unlike single family homes that are based upon comparables and determined by the market.
Yeah, and I think, like in my opinion, the reason why this is so important is because most people that are in the single family space, most people that are in that space, like most people that buy those properties, are emotionally attached to the property. And I think that's one of the things that we love about larger multifamily is that it is based on the numbers. What is the income? What is the expenses? What is the value add opportunity? Like it's just plain and simple. It's a business. It's a business, unlike single family houses where there's emotions, there's the stress, you're dealing with one property manager. I know we had a conversation about this, that some of their assets, they have their own leasing office. Within the leasing office, they have like anywhere from 5 to 10 people working in that office, leasing units, working on work orders, managing the property. But then there's also a property manager that manages. There's just a whole lot of team going on, and there's a lot of eyes that are taking over the asset. So it's actually easier to manage.
Yeah, and we went here when we were in Savannah, Georgia. We did a bit of secret shopping. So what I mean by that is we acted as tenants, and we went in and we talked to the leasing office. And to say the least, we had an excellent experience with the leasing agent. She was tremendous. She was caring. She was nice. She walked us through. She collected.
She goes through the process of what she does with tenants.
And that was really good. We're really impressed. And that's kind of the people on the team they're looking to work with when you're selecting people on the team.
Yeah, I know we talked with the in-house property management. I think we're going to be bringing her on board. So that'll be a good add to the team there. Let's see here. Yeah, no, that's it. Right. Okay, so myth number 4, and I think this is probably one of the most common myths right now. You may see it on the news, you may see it everywhere. You should wait until interest rates come down. And I think, the truth is, waiting for interest rates to decrease might mean missing out on advantage investment opportunities. High interest environments offer chances to secure properties at favorable prices. And by implementing strategic financial planning, positive cash flow can be achieved despite current rates. And I think the biggest mistake you can make right now is to stay in the sidelines and just wait for the interest rates to go up. I think more than that, you should actually be strategic. You should be creative with the deals, kind of like we're doing, right? With the assumable loans, You know, what is the issue right now going to the market? The interest rate. Okay, how do I avoid that, or how do I work around that? Well, we're finding that assumable loans are some of the best ways, because then you automatically get rid of the biggest hurdle right now, which is interest rates. So again, the biggest thing, the worst thing you can do is 5 years, 6 years go by and you regret not buying right now. I think that's probably the worst thing that you can do at the moment.
And myth number 5 is that the property value always declines in high interest environments. The truth is, with multifamily apartments are assessed based on the net operating income, not solely on interest rates. Since value is income driven, properties with strong earnings potentially have effective management and can maintain or increase the value even at a high interest rate environment. So that's what we love about multifamily, right? You can play with it up or down, whether the interest rates are up or low. It's just you know, case studying and
Yeah.
and understanding what's going on.
Yeah, and I mean, because you have so many more tenants. I mean, the deal that we, you know, the Silver one is just some deals that we've been working on, 170 plus units. So there's just a lot more income coming in, right? I know there's a lot of people in trouble right now in single family house, for instance, right? Or duplexes, right? If your mortgage went up, right, you can't just automatically put that on the tenants, or you can't increase the rent even more. But with the larger 100 plus units, you have so many tenants, right? So you're able to, you know, budget for that. You're able to underwrite based on that. You're able to just execute on a business plan and not be so dependent on that. I mean, like, I feel bad, honestly. I feel bad for the people that bought single family houses and now they're, you know, now they're in a sticky situation. So yeah, myth number 5, property values always decline in high interest. Again, so the truth is multifamilies are assessed. Oh, well, yeah, we're going over this. So that is the 5 myths that we're going over today. So we're just gonna do a little Q&A here. I know I'm live on Instagram, and then we got some people here on the chat here. Love this relish, true hustlers, much love. Thank you, Nito. Appreciate it. Just getting some positive feedback here from folks. So yeah, if you guys have any questions, you can write it on the Instagram live there, or you can put it on the chat here on the Zoom. Again, we host these monthly webinars, and we just mainly do it to bring value. We don't want anything in return. We just want to provide value. We want to educate folks around us, our investors, why we love multifamily, why we love larger multifamily, why we love the US specifically, and just want to educate and just bring value, right? More than anything, we just want to bring value. Anything you want to add, John, to the live here?
No, I think went over some pretty good points on how we're navigating the market in this high interest rates environment.
Yeah, and I wanted to go live here just to show folks a little bit about, what our webinars are usually about, how we, how they're set up, and, hopefully you guys can join us on Zoom next time. Okay, so Fabio, how do you guys deal with high insurance prices? Fabio, that's actually a great question. The way in which we deal with this is that we have a really good connection when it comes to insurance in the markets that we're in. And then also, this might not be a popular opinion, but we're staying away from places like Florida. We're staying away from Texas. We're staying stay away from those 2 specific markets right now because the interest rates have gone through the roof, specifically in Florida. I know that we were working on a deal out in Daytona Beach, beautiful asset, 200 plus units. I mean, it was B class. It was a phenomenal asset, and they're asking like 100, I think 130 a unit. So it was just a great opportunity. And we were underwriting it. We got some quotes that were coming in. Their quotes were coming in at $950. And by the time a month went by, we were last and final with another group, and when we got another quote from our provider, the insurance had gone from $950 to $1,500 per unit, which is a huge. It just killed the deal. I think we're going to offer like, I think 18 million, and we had to come down to 16 million. So then the deal didn't work out. And so what we're doing to mitigate that is we're staying in markets that are not really seeing those kind of increases in premium, like Georgia, like North Carolina, like South Carolina, and kind of staying away from like Florida, staying away from the Texas markets because the insurance have gone through the roof in those markets. And then also just having really good vendors, really good insurance brokers that we work with. Just to kind of give you guys perspective, some of the deals that we're currently underwriting and that we're working on, we're underwriting at a much higher price per unit. For instance, some of the deals that we got going on right now, we're underwriting at $1,000 per unit, and we've already gotten quotes, like pretty much firm quotes from brokers insurance brokers at $400, but we're keeping the underwriting at $1,000 just to have extra buffer and just to be able to give our investors a much better return.
Yeah, like we say, under promise, over delivered, and
Yes.
that's kind of what our motto is.
So yeah, probably that's kind of how we're dealing with insurance. I mean, insurance is, I used to be an insurance broker, so I have a little bit of experience in the space. Insurance is something that, you know, if you have a claim, the insurance companies will usually kind of bill you back with it by increasing your rates. So what you seen in Florida last year with was it a hurricane that happened? With a hurricane, there's I think billions of dollars, if I'm not mistaken, that's going to be spent by insurance companies. Well, where are they going to get that money from? They're going to charge the insurance clients there. So that's not going to be a pretty sight, and I don't think insurance is going to go down anytime in Florida or Texas. So again, how are we mitigating that? Good providers, staying away from Florida and Texas, and sticking in markets that don't really see a lot of hurricanes and tornadoes and things like that. So that's how we're doing that, Fabio. And great question. Thanks for asking that. Let me just see here. We'll wait a little bit more. If you guys have any questions on the Instagram live here, just put it in the chat, and we'll hang around here for a minute or two. But if not, then we'll. How do you guys deal with high? Okay, that's not it. Anytime, Fabio. And then let's just go here to the next slide. So again, we are in Canada, but we do help Canadians invest in the US into larger multifamily properties. Definitely, it's not an easy thing to find a deal, you know, do the diligence, you know, get financing, do all this. So any passive investors that come and invest alongside with us, they don't have to worry about any of that. They basically just invest with us, and then they enjoy the benefits of the investment. They get, you know, returns. They don't have to do anything. So just for instance, John, if you wanted to invest with us, how much work do you have to do?
Not much at all. Not much at all. You know, the diligence is obviously a big part. You know, we have a big meeting with a team, and we go over all the paperwork.
No, but as a passive investor.
As a passive investor, yeah, not much. No.
Right. So again, it's a very different vehicle, and again, why we love the larger 100+ unit buildings is because we cash flow from day one, which is not something you're able to do with the smaller multifamily properties. Fabio, go ahead.
You weren't talking about paperwork. You mean like completely hands off?
Yeah. Like what is a passive investment?
Yeah, it's completely hands off. Aside from, you know, subscription agreements and all that stuff, that's different.
Now, for people that are in the stock market or something, I actually wanted to get into the stock market, and then I could never figure the hang of it, because you have to study reports, you have to keep looking at where the market is, you have to predict. Whereas with us, again, it's all just numbers, right? So what is the rent? What is the income? What is the expenses? What is the rental growth? And it's just very straightforward business. I mean,
essentially allowing us full access and control.
Yes.
Over the value. With the assets.
Asking, how long have you guys been working on the multifamily space? I want to say close to 4 years now. I mean, you know, started off with single family, but we never really, you know, we kind of dove right into the multifamily space, smaller multifamily. And then, but again, our team, you know, because that's the thing about larger multifamilies, is that it's not about you, it's not about me, it's about what is the team, right? What has the team done? You know, what is the team's track record? Like, it's not about us, it's about our team, it's about our partners, right? And with that being said, you know, some of our partners have over 20 years in the space, right? So it just gives us a lot of confidence, and we're able to just have really good deals. Because what happens with the work that deal flow works in the States is that you're not going to have deal flow if you're just a new person starting out. You're not going to have deal flow if you're in Canada trying to get deals. You're going to have deal flow by creating relationships, meeting with brokers, being in the market. And I think that's a lot of people may not know that. So essentially, it's a lot of work. So if you just want to invest passively and just let your money work for you, let us take care of it, let a team that has a track record take care of it, then that's always when we help out. And here's just a little structure on how we help Canadians invest. Just a little structure, accounting-wise, you guys can always go to get money efficiently from in and out of Canada.
Yeah, and if anybody on the call has any more questions in regards to corporate structure or accounting questions, taxes questions, we can always sit down on the call.
Obviously, we're not, you know, we got to put that disclaimer out there.
We got to put that disclaimer out there, but we can always schedule a call and sit down with our security lawyers or our cross-border accountants. And if you have any questions about double taxation, forms, etc., we can always sit down and go over it more in detail.
Yeah. So the disclaimer is obviously we're not lawyers, we're not accountants or investors. So you should seek advice. But yeah, this is our website. So if anybody is interested, they want to invest with us, they know anybody who may be interested in investing passively. We have some really exciting opportunities that we are definitely going to be presenting to some of our investors. So definitely reach out to us. These are some really exciting properties in amazing markets. So Fabio here just has a question. I'm just going to go over that. So do you guys prefer to invest in the US or Canada? So that is an easy question. An easy answer rather, sorry. And the answer is?
Yeah, the US, of course.
And again, since we're live here and we got a little bit of time here, why are the reasons that we love the US over Canada? I'll go over a few and maybe John can go over a few. The first one is, and the most important one, it's a land. We do cash for keys. We don't have to try to negotiate with them. We simply give them notice that we're increasing the rent or that we're going to be renovating the unit. And that's basically it. So they either leave or they get kicked out. What happens if they don't pay rent, right? You have, I know we were really impressed with the property manager over the weekend there, or a couple days ago. She said that it takes 30 days to evict a tenant in the markets that we're in. 30 days. I know that, one of the biggest hurdles that we had here in Canada is that we had tenants that were not paying. We had a tenant that went a year without paying rent because damage to the units in Canada. So that's just a massive one. What else? Besides from the landlord friendly.
Rental, high demand, population growth, job growth, weather.
What about what was I gonna say? What about
Diverse.
what about the assets?
Yeah, the assets. I mean, yeah, for sure. The assets.
Talk about the assets.
The assets is nothing like you see here in Canada.
How many 100+ units have you seen in Canada?
Not many.
On the market or
Not
just in
many.
general?
Not many. Not
Right.
many as how we do in the States, and the amenities are
Yeah,
uncomparable. The weather, like I said, the diversity and the economics across cities when it comes to healthcare, job growth, population, is a different beast.
Yeah. Basically, I mean, you want to do it slow, do it in Canada. You want to do it fast, do it in the States. That's the best way I can describe it. We're looking to scale up. We're looking to, have $1 billion under management in the next 10 years. So we have big goals, and unfortunately, we can't achieve those in Canada just based on the landlord rules. It's just, it's just not very business friendly.
It's more capital driven in the US.
Yeah.
Right. Lots of.
So yeah, to answer your question, Fabio, the US all day, every day. We love Canada, but investing wise,
it's not sustainable.
it's not sustainable. Yeah, it's just simply not sustainable. Yeah. So in the US is the answer, Fabio. That's where a lot of our larger properties we have. However, we do have properties in Canada, but yeah, it's a different ballgame. You're talking
Peas to pecans.
You're talking McDonald's to Chick-fil-A. All right, guys. Well, that's it for today. I hope you guys got some value. If you are not on our investors list, make sure to join us here. I'm just sharing our website. Our website is Ortiz Equity Group. And again, what we do is we help invest in that pathway in large multifamily in the US. And we don't just bring in investors, we also have American investors. And last thing I wanted to share, guys, here is how you can build wealth through large multifamilies. And just as we kind of wrap up here. And what happens essentially, let's just say you invested 100,000 today, 2023, in 2.5 to 3 years, that 100,000 usually will get multiplied 2 to 2.4x. So 100,000 in 3 years will turn into 200,000, 240,000. And then in another 2-3 years, that 200,000, if you were to invest it again, it would turn into 400,000. So now we're talking about like less than what is that? 3, 6, 9 years. Your 100,000 went from 200,000, then 400,000. Now, if you do that another 2 years, so if you do another 3 years later, you do it again, that 400,000 can turn into 800,000 And then if you do it again, you know, reposition the asset, and then you want to invest that 800,000. What does that 800,000 turn into, John?
1.6.
$1.6 million. Now, the beauty of this is that at $1.6 million, if you're, you know, projecting cash on cash return is 8 to 10%, that means you're getting over $16,000, right? If I'm not mistaken, $16,000 a month of cash flow. Now, do you think you'd be able to retire with $16,000 a month of passive cash flow? Like passive, like this is passive. This means you don't do anything. You could be in Bahamas, you could be in New York, you could be in California, and that's consistent cash flow. So that is how you're able to build wealth through multifamily. Now, not to get crazy, but 1.4 million, let's say you invest 1.4 million, and then you multiply that or 2x that. That's how you build wealth with multifamily. Most people will work 30, 40 years in a job and will never have passive income or build wealth. So that is why we love multifamily. That is why we love what we do, and we're able to help other folks, you know, retire and be financially free. So just wanted to add that to that. But yeah, that's it for today, guys. So thank you guys for joining us. We appreciate it and hope you get tremendous value. Yeah, we'll be wrapping up here.